Hi all. So what actually happened in Tiger Global case? Let's talk about it. January 2026, Supreme Court of India ruled against Tiger Global and ordered them to pay $1.7 billion tax. What's the whole story behind it? Let's start from beginning. From 2011 till 2015, Tiger Global formed three companies in Mauritius and through which investment came into Flipkart India. 2018, Walmart bought Flipkart and paid billions of dollars to Mauritius, more than 4 billion or something. Well, Tiger Global Mauritius said we are not even going to pay a single dollar of tax in India. Why not? Flipkart India was being sold. Tiger Global claimed that there is a treaty DTAA between India and Mauritius that exempts capital gain income. Well, fine. This all happened in 2018. Interestingly, there's something called GAAR introduced in 2017, General Anti-Avoidance Rules, that says the taxman or the Indian Income Tax Department has an authority to actually go behind the legal ownership documents and look who is the beneficial. Look where the business is actually being run from. Look where is the being control exercised. So Mauritius, Tiger Global Mauritius came and provided this legal document saying that this is a Mauritius company, tax residency certificate saying that we are being taxed in Mauritius. The Indian government should not be charging tax. Well, the court and the Income Tax Department said that's all is fine. The tax residency certificate has to be there. That's all okay. It's very well being put on the paper. But what is actually happening behind the paper? And that was invoked through 2017 GAAR rules. The authority, the taxman, has a right to go behind the curtain and see who is actually running the company. Is there a real business being run from Mauritius? Are the head brain of the business in Mauritius, or is it being run from US? So what they actually came up with, that Mauritius is just the mailbox. It's just a conduit, but actual operations were run from US. Management was exercised from US. The investors pooled in the money and brought it into Mauritius company. Everything was being controlled from US. So the treaty, the benefits between India and Mauritius could not be given. Well, there's something more interesting. 2017, Mauritius and India double tax avoidance agreement went through an amendment. It actually said from the amendment, the tax will be based on the source of the income, not anymore on the residence. So earlier, if the company was being resident in Mauritius, that was enough to prove that this is a Mauritius company and they should be exempt from taxes. But now they also have to see what is the source of the income, and the source of the income is from India. Indian assets were being sold. What is actually telling us? Years of tax planning that went behind it has actually become a tax risk for the future. This is just one case of its kind. A second case from Blackstone is going on. Delhi High Court ruled in favor of Blackstone, which is another huge investor, giant from Wall Street, who has invested big time into Indian startups and Indian. Delhi High Court in January 2023 said, well, the treaty between Singapore and India says the legal ownership is sufficient. The TRC is sufficient. There's nothing to look beyond it. The legal residence is in Singapore. Singapore doesn't have capital gain, or they're not supposed to pay anything in India. This is again being now taken up in Supreme Court. Let's see. The whole case, the whole judgment that came from Tiger Global, the precedent would have a very huge impact on the current Blackstone case, which is still being heard in Supreme. Let's see what it brings on the table, both for investors and for the startup. Thank you.